the strategy. Okay, so this is just the hierarchy as far as what our outlook is for this strategy. We're going to focus on buying longer term, deep in the money option contracts. Now, what's important about this is that we have very liquid markets, or we're looking at stocks that are fairly liquid, because as you get deeper and deeper in the money, you run into situations where bid-ask spreads get a little bit wide. But we're going to try to manage that by the underlyings that we are looking to trade. We're going to go about 6 months out in time, and that's going to be dependent on what's going on in the marketplace, but that's our target. We're going to look at individual stocks and ETFs. So not only are we going to talk about stocks, we will from time to time look at certain sectors of the marketplace and look at ETFs. One of the great things about ETFs is most of them, the ones that we'll be talking about in general, are very liquid. They have very solid markets, and they're a little bit lower priced than some of the individual stocks that we have, which also means that you can buy more option contracts that track around that ETF. Because we're going to look at allocating a specific percentage of your portfolio to every position that we decide to put on. So here we go. We have deep in the money calls, and by that, how do we judge the deepness, I guess, would be the question. And we're going to do that with delta. So we're going to look at about an 80 delta. Now, if you're a beginning option trader, don't let that word scare you. It just really means that you're going to get something that acts a lot like the stock. So the whole guts of this strategy is that we are going to buy an option contract as a surrogate for buying the stock outright. So we want a lot of stock price representation. So I'm going to give you a different definition of delta as far as this is concerned. I see the video and the audio. Okay, so we don't have any audio issues, I don't think. I think we're looking good, everybody. Give me a thumbs up in that chat box if we are. Okay, so if I'm looking at this, if I'm thinking about delta, here's the different way to think of delta. That, and I'm going to point to it on the slide here, is that it represents 80% correlation to the stock price movement, right? So if I have a delta of 0.80, I look at the option contract, it says 0.80. I know that option contract represents 100 shares of stock. If I take 100, multiply that by the delta, we come up with 80. So in this situation that we're talking about, the way that I want to think about delta is that it's going to represent basically 80 shares of stock, or as I have highlighted on the slide, an 80% correlation to the stock price movement. Another way to say that is if the stock goes up 1, your option contract in theory should go up by about 80 cents. All right, so if you have 100 shares of stock, you would make $1 on the stock, you'd be up $100. On the option contract, you'd have one contract, represents 100 shares, you'd be up $80. So there's many different ways to think of delta, but as far as this strategy is concerned, we think of it as the number of shares of stock that option contract represents. Now, it's cost effective. They require less capital than the outright purchase. That is all true, but it's still an option contract. It still has an expiration date. It still has time premium. So those things we have to address. So our allocation model is we're going to look at taking 10% of the portfolio for the underlying that is chosen. So like if you have $100,000 of stock and you just chop that up into 10% increments, you could have as many as 10 stocks inside that portfolio. And we'll probably stick somewhere around that. That will probably be the test model, or whenever we're looking at at allocations and giving out numbers of contracts that we want to buy, it's probably going to be somewhere like that. That would be basically our test portfolio that we'd be looking at. And so 10% would mean that we could buy 10 stocks. Now, 10 stocks is a lot. Most of the time, I think we'll be somewhere between 5 and 7, but we want to keep it open, right? We're going to be flexible in this. Very rarely are we only going to have 1 or 2 positions on, and sometimes we'll take some off and then let that money settle and give it a few times until we find another opportunity. So we're not going to just fill up the portfolio to fill up the portfolio, if you will. We're going to be looking for specific stocks that fit our criteria that we can put inside of that portfolio. Okay, So this strategy offers significant leverage with a reduced initial amount of capital. So what I have found from my mini, I've been teaching options for over 30 plus years. When I'm doing this strategy and I'm talking about it with investors, if I go out about 6 months in time and I look at the price of the stock and I look at an 80 delta option contract, it's usually about 20% of the capital needed to purchase 100 shares of stock. So that's not always the case. Some big things that matter is how volatile is the underlying. If it's less volatile, then you're not paying as much implied volatility premium. So usually the option contract will be a little bit cheaper. It just kind of goes hand in hand. Once again, it's all about how you want to think about that option contract that you're buying. But typically, it's if you're going to go out 6 months in time, you're looking at an 80 delta option contract. That means you're deeper in the money. You're going to be putting up about 20% of the capital needed to purchase 100 shares of stock. So with that said, sometimes I have taught deep in the money option contracts, and I think that if you were going to buy 100 shares, this is one way that you can limit your risk. And as opposed to buying that 100 shares, let's just buy one contract. Well, we're going to use the leverage a little bit more. If we were thinking about buying 100 shares, we might buy 2 or 3 contracts. It's going to be all about the portfolio allocation as opposed to just thinking of it as on a per contract or a per share basis.